over a time frame of, over a duration of about 25 to 30 minutes over the last 3 to 4 years, especially since the onset of the pandemic, has become an important instrument which has enabled the Reserve Bank to communicate the gist of the monetary policy decisions and the rationale behind it. And what is more, this has also given us an opportunity to explain Reserve Bank's assessment of the overall economic situation, both global and domestic, and also our assessment of the prevailing financial market conditions. So in that way, I think this has enhanced the entire process of communication from the Reserve Bank to a wider cross-section of people and stakeholders. So in that sense, we have great amount of satisfaction from doing that. And from time to time, we have been getting suggestions from many of you. And we try and incorporate your suggestions also into our statements and into our communication. Thank you very much for that. And the statement is as follows. As I make this monetary policy statement, we can derive satisfaction from the fact that the Indian economy and the financial sector stand out as strong and resilient in a world of unprecedented headwinds and swift cross-currents. Unlike the previous 3 tumultuous years, the uncertainty on the horizon appears comparatively less and the path ahead somewhat clearer. But we have to be acutely aware that the geopolitical conflict continues unabated and policy normalization globally is far from complete. Headline inflation across countries is on a downward trajectory, but is still high and above the targets. Labor markets in many countries are tight and demand is rotating back from goods to services. Hence, central banks across the world remain on high alert and watchful of the evolving conditions, even though many of them have tempered their rate hikes or even taken a pause. Financial stability concerns persist in advanced economies, although they appear to have been contained due to resolute actions. Retrenchment in trade, technology, capital flows caused by geopolitical fault lines and economic fragmentation further complicate the situation. In these challenging times, the Reserve Bank of India has continued to focus on preserving price and financial stability, while ensuring adequate flow of financial resources to all productive sectors of the economy. As a result, domestic macroeconomic fundamentals are strengthening. Economic activity is exhibiting resilience. Inflation has moderated. The current account deficit has narrowed, and foreign exchange reserves are comfortable. Fiscal consolidation is also ongoing. The Indian banking system remains stable and resilient. Credit growth is robust and domestic financial markets have evolved in an orderly manner. Let me now turn to the decisions and deliberations of the Monetary Policy Committee. As many of you would be aware, the Monetary Policy Committee met on 6th, 7th and 8th June, and based on an assessment of the macroeconomic situation and outlook, the MPC decided unanimously to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility and the bank rates, they stand at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. Let me now explain the MPC's rationale for these decisions on both policy rate as well as the stance. The MPC recognized that the pace of global economic activity is expected to decelerate in 2023, that's in the current year. And this is mainly because it is getting dragged down by elevated inflation, tight financial conditions, and geopolitical tensions, which are still continuing. The pace of monetary tightening has slowed in recent months, but uncertainty remains on its future trajectory as inflation continues to rule above targets across the world. And in the last few days, you would have noticed that two major central banks have, after adopting a pause for several months, they have gone for increasing the policy rates. So therefore, what I am saying is that the monetary policy, the pace of monetary policy has slowed, tightening of monetary policy has slowed down, but uncertainty remains on the future trajectory as inflation continues to roll above targets across the world. In India, consumer price inflation eased during March-April 2023 and moved into tolerance band, declining from 6.7% last year, that is 22-23. Headline inflation, however, is still above the target as per the latest data and is expected to remain so according to our projections for 23-24. So when I say headline inflation is still above the target, I am referring to headline inflation as per our assessment will remain above 4% throughout 23-24. Therefore, close and continued vigil on the evolving inflation outlook is absolutely necessary, especially as the monsoon outlook and the impact of El Nino remain uncertain. Real GDP growth in 2022-23, on the other hand, turned out to be stronger than anticipated and is holding up well. The policy repo rate has been increased by 250 basis points since May last year and is still working its way through the system. Its fuller effects will be seen in the coming months. Against this backdrop, the MPC decided to keep the policy repo rate unchanged at 6.5%. The MPC will continue to remain vigilant on the evolving situation and the growth outlook. It will take further monetary policy actions promptly and appropriately as required to keep inflation expectations firmly anchored and bring down inflation to the target. With the policy repo rate at 6.5% and full year projected inflation for 23-24 at just a little above 5%, the real policy rate continues to be positive. The average system liquidity, however, is still in surplus mode and could increase as rupees 2,000 banknotes get deposited in the banks. Headline inflation, as noted before, is easing but rules above the target, warranting close monitoring of the evolving price dynamics. Taking all these factors into account, the Monetary Policy Committee decided to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. I would now proceed to provide our assessment of growth and inflation. Let me first focus on growth. India's real gross domestic product, that is real GDP, recorded a growth of 7.2% in 2022-23, stronger than the earlier estimate of 7%. It has surpassed its pre-pandemic level by 10.1%. Real GDP growth in the fourth quarter of 22-23 accelerated to 6.1% year-on-year from 4.5% in the third quarter of last year, aided by fixed investment and higher net exports. On the supply side, real gross value added, that is GVA, accelerated from 4.7% in Q3 to 6.5% in Q4, driven by rebound in manufacturing activity, which moved into expansion territory after 2 quarters of contraction. Turning to 23-24, domestic demand conditions remain supportive of growth on the back of improving household consumption and investment activity. Urban demand remains resilient with indicators such as passenger vehicle sales, domestic air passenger traffic, and credit cards outstanding posting double-digit expansion on year-on-year basis in the month of April. Rural demand is also on a revival path. Motorcycle and three-wheeler sales increased at a robust pace year-on-year in April, while tractor sales remained subdued. Growth in steel consumption and cement output and production and imports of capital goods suggest continued buoyancy in investment activity. On the back of double-digit growth of 15.6% in non-food bank credit, the flow of resources to commercial sector in the current year, that is 2023-24, up to May 19th, increased to 2.7 lakh crore from 1 lakh crore during the same period last year. Fixed investment by manufacturing companies expanded in 22-23, reversing the contraction seen in 21-22. Our surveys also point towards higher investment intentions of manufacturing companies for 23-24, that is for the current year. The contraction in merchandise imports outpaced that of merchandise exports in April, resulting in a narrowing of trade deficit. Coupled with sustained and strong growth in services exports, the drag from net exports on growth is easing. On the supply side, the 8 core industries output expanded by 3.5% year-on-year in April, compared with 3.6% in the month of March. The Purchasing Managers Index, that is PMI for manufacturing, exhibited sustained expansion, rising to 58.7 in the month of May, which is a 31-month high. Available high-frequency indicators suggest that services sector activity has remained on an accelerating trajectory. PMI services remained in strong expansion at 61.2 on top of 62 in April. Looking ahead, higher Rabi crop production, expected normal monsoon, continued buoyancy in services, and softening inflation should support household consumption. On the other hand, given the healthy twin balance sheets of banks and corporates, supply chain normalization, and declining uncertainty, conditions are now favorable for the capex cycle to gain momentum. Robust government capital expenditure is also expected to nurture investment and manufacturing activity. Consumer and business outlook surveys display continued optimism. The headwinds from weak external demand, volatility in global financial markets, protracted geopolitical tensions, and intensity of El Nino impact, however, pose downside risks to the outlook so far as growth is concerned. Taking all these factors into consideration, the real GDP growth for 2023-24, that is for the current year, is projected at 6.5%, with Q1 at 8%, Q2 at 6.5%, Q3 at 6%, and Q4 at 5.7%, with risks evenly balanced. Let me just give the figures once again. So the GDP growth, real GDP growth projection for the current year 23-24, the projection that we are making is 6.5%, and the quarterly breakup is as follows. The first quarter, the estimate is that it would be 8%, second quarter 6.5%, third quarter 6%, and fourth quarter 5.7%, and the risks are evenly balanced. Let me now turn to inflation. Headline CPI inflation has come down during March-April 2023 to 4.7% in April, the lowest reading since November 2021. Monetary policy tightening and supply-side measures contributed to this process. The easing of inflation was observed across food, fuel, and core, that is the CPI excluding food and fuel categories. That means all categories of headline inflation witnessed, what you call easing of the inflation pressures. Food inflation declined to 4.2% in April, while core inflation moderated to 5.1%. A durable disinflation in core component would be critical for a sustained alignment of the headline inflation with the target. Going forward, with the recent Rabi harvest remaining largely immune to adverse weather events, the near-term inflation outlook looks more favorable than at the time of the last MPC meeting in April. The forecast of a normal southwest monsoon by the Indian Meteorological Department, IMD, augurs well for the Kharif crops. Uncertainties, however, remain on the spatial and temporal distribution of monsoon and the interplay between El Nino and the Indian Ocean dipole. Geopolitical tensions, uncertainties around the monsoon and international commodity prices, especially sugar and rice and also crude oil, and the volatility in global financial markets pose upside risks to inflation. Taking into account these factors and assuming a normal monsoon, CPI headline inflation is projected at 5.1% for 23-24, with Q1 at 4.6%, Q2 at 5.2%, Q3 at 5.4%, and Q4 at 5.2%. The risks are evenly balanced. As noted in the April statement, the decision to pause was based on the need to assess the cumulative impact of past monetary policy actions while charting out our future course. Subsequent incoming data suggest that while risks to near-term inflation have moderated somewhat, pressures remain during the second half of the year, which needs to be watched and addressed at the appropriate time. According to our survey, inflation expectations of households for 3 months to 1 year ahead horizon have moderated by 60 to 70 basis points since September 2022. This would indicate that anchoring of expectations is underway and that our monetary policy actions are yielding the desired results. This also provides us the space to keep the policy rate unchanged in this meeting of the MPC. At the same time, given the uncertainties, we need to maintain Arjuna's eye on the evolving inflation scenario. Let me re-emphasize that headline inflation still remains above the target, and being within the tolerance band is not enough. Our goal is to achieve the target of 4% going forward. As Mahatma Gandhi had said, the ideal must not be lowered. The continuation of stance of withdrawal of accommodation should be seen from this perspective. I would now like to turn to liquidity and financial market conditions. Surplus liquidity has, as reflected in average daily absorptions under the LAF at rupees 1.7 lakh crore during April-May, was lower than 2.9 lakh crore rupees during the full year 22-23. The shrinkage in surplus liquidity during April-May was, among other things, due to maturing of the TLTROs which we had extended, which we had given during COVID times. The seasonal expansion in currency in circulation and build-up of government cash balances during this period also moderated surplus liquidity. Since the third week of May, however, the decline in currency in circulation and pickup in government spending have expanded system liquidity. This has got further augmented due to the Reserve Bank's market operations and the deposit of rupees 2,000 banknotes in the banks. The prevalence of surplus liquidity amidst higher recourse to marginal standing facility MSF by some banks suggest skewed liquidity distribution within the banking system. To address this situation, the Reserve Bank conducted a 14-day variable rate auction, that is a VRR auction, amounting to rupees 50,000 crore as part of its main operation on May 19, 2023. Similar to two such auctions conducted earlier in February and March this year. Reflecting swiftness in its liquidity action, the Reserve Bank conducted a 14-day variable rate reverse repo auction. The earlier one I referred to was variable rate repo auction. Now I am referring to variable rate reverse repo auction, which is VRRR. So reflecting the swiftness in its liquidity action, the Reserve Bank conducted a 14-day variable rate reverse repo auction, that is a VRRR auction of 2 lakh crore on June 2nd. And thereafter we have gone on to conduct a 4-day VRRR auction of 1 lakh crore on June 5th, a 3-day VRRR auction of 75,000 crore yesterday, day before, that is on June 6th, and a 2-day VRRR auction, let me say, a VRRR auction of 75,000 crore on June 7th. Now this was done considering the overall build-up of surplus liquidity. The response to these auctions, these VRRR auctions, has been cautious in, as per our experience, that is these VRRR auctions which we conducted over a period of last 4 or 5 days. The response from the banks has been fairly cautious. Going forward, the Reserve Bank will remain nimble in its liquidity management while ensuring that adequate resources are available for the productive requirements of the economy. The Reserve Bank will also ensure the orderly completion of the government market borrowing program in the current year. The moderation in system liquidity, along with its skewed distribution, was reflected in firming up of money market rates even beyond the repo rate on a few occasions before they came down from May 18 to sub-repo rate levels. Long-term rates have, however, remained broadly stable. This has led to sharp compression of term spreads in the recent period. The relative stability of long-term yields augurs well for the economy and suggests effective anchoring of market-based long-term inflation expectations. I would now like to briefly talk about the external sector. In recent months, the trade deficit has narrowed on the back of sharper decline in imports vis-à-vis exports. India is making resolute strides to achieve the $1 trillion merchandise export target by 2030 by focusing on diversification of markets and products, leveraging free trade agreements, strengthening manufacturing capacity and competitiveness by participating in value chains, and through schemes such as the production-linked incentive across sectors. Service exports and remittances have provided valuable support to India's external sector viability. During 22-23, services exports grew faster at 27.9% than merchandise exports, which grew by 6.9%. The current account deficit, that is expected to have moderated further in Q4 22-23 and should remain eminently manageable even in 23-24, that even in the current year also. On the financing side, foreign portfolio investment, that is FPI flows, have seen significant turnaround this year since April, that is in 23-24, led by equity flows. The net FPI inflows stand at US $8.4 billion during the current financial year up to 6th of June, as against net outflows in the preceding 2 years, and the net outflows in the preceding 2 years were US dollar 14.1 billion in 21-22 and 5.9 billion last year in 22-23. Net FDI flows to India were $28 billion in 22-23 compared to $38.6 billion in the previous year. Preliminary data for April 23 suggest that FDI flows have also improved. Net inflows under non-resident deposits, net resident inflows under non-resident deposits increased to $8 billion during 22-23 from $3.2 billion in the previous year. The Indian rupee has remained stable since January this year. Overall, India's external sector remains resilient as key indicators such as current account deficit to GDP, external debt to GDP, and international investment position, IIP to GDP, all these ratios continue to improve. Foreign exchange reserves stood at a comfortable level of US dollar 595.1 billion US dollars as on 2nd June this year. Inclusive of net forward assets, our foreign exchange reserves are well above 600 billion US dollars. I shall now announce certain additional measures. There are about 8 additional measures, and I think all of them are quite important, so I request your patience for some more time. The first announcement relates to borrowing in call and notice money markets by scheduled commercial banks. The extant regulatory guidelines prescribe prudential limits for outstanding borrowing in call and notice money markets for scheduled commercial banks. With a view to providing greater flexibility for managing their liquidity, it has been decided that scheduled commercial banks, excluding small finance banks, can set their own limits for borrowing in call and notice money markets within the prescribed prudential limits for interbank liabilities. Second announcement relates to widening the scope of framework for resolution of stressed assets. Compromise settlements is recognized as a resolution mechanism in respect of non-performing assets, that is NPAs, under the prudential framework of the Reserve Bank, which is currently applicable to scheduled commercial banks and select NBFCs. It is proposed to issue comprehensive guidelines on comprehensive settlements and on technical write-offs, which will now be made applicable to all regulated entities, including the cooperative banks. Further, it is also proposed to rationalize the existing prudential norms on restructuring of borrower accounts affected by natural calamities. The next announcement relates to a default loss guarantee arrangement in digital banking, popularly what is known as the FLDG in digital banking. The Reserve Bank had issued the regulatory framework for digital lending in August-September last year. With a view to further promoting responsible innovation and prudent risk management, it has been decided to issue guidelines on default loss guarantee arrangements in digital lending. This will further facilitate orderly development of digital lending ecosystem and enhance credit penetration in the economy. The next announcement relates to priority sector lending targets for primary urban cooperative banks. The Reserve Bank has undertaken several initiatives in recent years to strengthen the urban cooperative bank sector, that is the UCB sector, as well as to deepen financial inclusion. Such initiatives include revision of the priority sector lending targets for UCBs in 2020. While revising the priority sector lending targets, a glide path up to March 2024 was provided for a non-disruptive transition to achieve the revised targets. While a number of UCBs, that is urban cooperative banks, have met the required milestones as on March 2023, a need has arisen to ease the implementation challenges faced by the other UCBs. It has therefore been decided to extend the time frame for achieving the targets by 2 more years, that is up to March 2026. Further, urban cooperative banks, UCBs, which have met the targets as on 31st March 2023, shall be suitably incentivized. The next announcement relates to rationalization of the licensing framework for authorized persons under Foreign Exchange Management Act, that is FEMA. The licensing framework for authorized persons issued under FEMA was last reviewed in March 2006. Keeping in view the developments, including progressive liberalization under FEMA over the last several years, and to effectively meet the emerging requirements of the rapidly growing Indian economy, it has been decided to rationalize and simplify the licensing framework for these authorized persons. This is expected to improve the efficiency in delivery of foreign exchange facilities to various segments of users, including common persons, tourists, and businesses. The next announcement relates to expanding the scope and reach of e-rupee vouchers. At present, purpose-specific e-rupee digital vouchers are issued by the banks. It is now proposed to expand the scope and reach of e-rupee vouchers by permitting non-bank prepaid payment instruments issuers, that is PPI issuers, to issue e-rupee vouchers. It is also proposed to enable issuance of e-rupee vouchers on behalf of individuals and to simplify the process of issuance, redemption, and a few other aspects of the current framework. These measures will make the benefits of e-rupee digital voucher accessible to a wider set of users and further deepen the penetration of digital payments in the country. Next announcement relates to streamlining the Bharat Bill Payment System processes and membership criteria. The Bharat Bill Payment System, that is BBPS, is operational since August 2017. The scope of BBPS was further expanded in December 2022, that is December last year. To further enhance the efficiency of the BBPS system and to encourage greater participation, it is proposed to streamline the process flow of transactions and membership criteria for operating units. The next announcement, and I think that's the last one, relates to internationalizing issuance and acceptance of the RuPay cards. RuPay debit and credit cards issued by the banks in India are gaining increased acceptance abroad. It has now been decided to permit issuance of RuPay prepaid forex cards by the banks. This will expand the payment options for Indians traveling abroad. Further, RuPay cards will also be enabled for issuance in foreign jurisdictions. These measures will expand the reach and acceptance of RuPay cards globally. Let me now conclude, and there are some important messages in this concluding para, so I request again your patience for just a couple of minutes. We have made good progress in containing inflation, supporting growth, and maintaining financial and external sector stability. Despite 3 years of global turmoil, India's growth has bounced back and headline CPI inflation is easing. This confluence of factors gives us the confidence that our policies are on the right track. Nevertheless, we need to move towards our primary target of 4% inflation. It is always the last leg of the journey which is the toughest. I wish to emphasize that we will do whatever is necessary to ensure that long-term inflation expectations remain firmly anchored. The best contribution of monetary policy to the economy's ability to realize its potential is by ensuring price stability. The Reserve Bank will remain watchful and proactive in dealing with the emerging risks to price and financial stability. Let me end by recalling the inspiring words of Mahatma Gandhi. If we are determined, we shall find the way that leads us to our goal. Thank you. Namaskar.
Well, you will have to admit that an expected dovishness is not there. As expected, a pause. As expected, not a comma changed in the stance, aligning inflation to the target while supporting growth. So withdrawal of accommodation remains. Nothing changed. But I would say where an expected dovishness was disappointed was that the inflation target was expected to come perhaps to 5. That was the conservative estimate. There were a few hopes that it would go even below 5, but at 5.1, it's neither here nor there. So the governor has not exuded that level of dovishness over the inflation target. Maybe they have it in their mind, but they don't want to express it, probably because of El Nino. And the repeated insistence that they will not be satisfied by simply coming within the broad range of 4% CPI plus or minus 2%, that is, coming below 6 is not enough. The target of 4% will be important. In various ways, he emphasized that several times. So I would say, if you were looking for dovishness, you were disappointed. It was almost a cut-paste of last time's policy. There has been a minor shuffling in the GDP growth forecast, with the first quarter GDP bumped up and the latter quarters 3 and 4 brought down. Likewise, in inflation, the first 2 quarters brought down and the latter quarters remaining unchanged. So overall, just a 10 basis point cut in the inflation forecast for the current year. It's very, very much a status quoist and cautious policy. Governor not willing, or rather the MPC and the RBI not willing to relinquish any vigil. The bond market yields were already higher before we went into the policy. They were standing at 7.002% just as the governor started, and they are now at 6.99 thereabouts. So it's actually moved down a bit, but that was only because the market had already gone in cautious ahead of the policy, and therefore there was just a minor give back. You might say the bond market reaction actually is marginally negative compared to where it closed yesterday. Well, those are the preliminary observations. Ritu, anything you want to add, or we can straight away go to Kaushik and Abhik for their observations? Ritu.
That's right, Lata. I mean, you know, the primary focus, I thought, something we weren't really expecting, because is the insistence that 4% is not enough, you know, that 2 to 6% is not enough, and then we have to get to 4% inflation. I think that was one of the biggest takeaways. But on that note, let me invite in our experts to decode the policy for us. Kaushik Das still with us, Chief Economist, Deutsche Bank. Abhik Barua from HDFC Bank. Amandeep Chopra, Group Head of Fixed Income at UTI Mutual Fund. And Ashwani Kumar Tiwari, MD of Risk and Compliance and Managing Director at State Bank of India with us. Gentlemen, thank you very much for your thoughts. Quickly, Mr. Barua, let me come to you. What were your key takeaways from the governor's statement?
Well, I thought it was an objective assessment of things, with a tinge of dovishness, in the sense that the way he characterized the economic situation was the proverbial sort of Goldilocks scenario. Everything seems under control. Yes, of course, there are risks, but he's not being alarmist about it. I think only those who had expected a change in stance, which I think the majority was not expecting, would have found it a little disappointing. But otherwise, I think both the revision, the fairly dramatic revision in the first quarter inflation forecast, the second quarter is revised down a tad. Maybe they are being cautious about the second half, but that could also come down. So I think the fact that he emphasized that India was in a good place, whereas various other countries, especially in the developed world, had their fairly acute problems persisting, was kind of hinted at a level of comfort, which I think the markets should draw some comfort from. Well, the 4% target is certainly there. That has been emphasized in the past. The Arjuna bit constant vigilance has been emphasized in the past. I don't see this as a sort of new development or a sign that they are getting they are now focusing on the long term, and hence that will change the rate or
Yeah.
the liquidity management trajectory in any significant way.
Got it. Yeah, got it, Abhik. Let me just get quick comments from the others and we'll come back to you. Mr. Ashwini Tiwari of State Bank of India with us, so the biggest bank. What have you all made of it, Mr. Tiwari? First of all, thanks for joining. It is status quo, but I think the big relief for banks, and now we have to call it a relief, is that there is no sign that they are going to cut anytime soon. I don't know what the swap market is saying right now, but your reaction, do you think there is space for loan rates to go up, lending rates?
So I don't think the loan rates are going to go up in any significant manner. Some of the banks are still not fully caught up with the RBI cycle because the reset in MCLR and the various scenarios is at a 6-monthly, 1-year kind of trajectory in some cases. So that catching up will happen. But in terms of general pickup of loan rates, especially in the EBLR kind of rates, I don't think there will be any increases by the banks because the Reserve Bank is clearly indicating that the status quo or peak cycle has been reached. So the banks will stay the course, and of course the natural increases will happen linked to the MCLR.
Okay. Well, just a word on the stock markets as well. I think they remain at about 0.25% higher, 40-45 points higher for the Nifty. So the Reserve Bank has not given the necessary bump up for the market to reach out to the skies. But maybe the market may ruminate over it. There's still nothing negative at all for financial markets, but perhaps a sharper cut in the inflation forecast or even a smidge of an increase in the GDP forecast may have been a bigger tonic for the equity markets. That's not come. It's so status quo as it gets. Kaushik, your thoughts? Do you think that an expected dovishness is lacking? Just your takeaways.
Lata, I think, it's along expected lines. Whatever we expected happened. I told you earlier that even if they could mathematically reduce inflation to 5%, probably they would be cautious and just do maybe 10 basis points just to keep some buffer. That's exactly what has happened. But, I will contradict a bit with, Abhik, and I think it's actually hawkish on the margin if you read through the, different statements. One, which you pointed out, the governor is now repeatedly saying that don't get complacent about the fact that we have come to 5% and that RBI is more or less happy with 5%. Our target is 4% and we need to go to 4%. That's why he mentioned that we are not going to go below 4% or close to 4% in FY24 at all as far as inflation is concerned. So he is indicating to market that our target is 4% and we have to reach there, and for that whatever we need to do and hold on for a longer time, we'll do that. So that's a bit hawkish on the margin, and they're repeating that continuously from now on. The second part is, I think you observed that you mentioned somewhere that core inflation has to come down durably in order to get to that 4% headline CPI target, which means that RBI is also focusing quite hawkishly on core inflation, because unless core inflation converges towards 4%, RBI probably would not be very happy or inclined to cut interest rates. So the takeaway from all this, and looking at the inflation forecast, if you see October, December is at 5.4, January, March next year is retained at 5.2. RBI is not going to cut anytime soon, and we know that the Fed is probably going to hike in July, and probably the Fed will only cut in March of next year. So whoever was expecting, or if markets were expecting that October, December RBI could move by cutting rates, we don't see any kind of reason why RBI should. And if you look at the growth forecast, actually 8% for April, June, when markets are at 7%, and 6.5 for July, September, it's quite on the bullish side. And consensus is for a 6% growth this year. RBI is for 6.5. But if RBI's forecasts are met, then the logic for rate cuts get pushed back, and probably in April of next year is when you could expect RBI to start cutting rates, and we have a prolonged extended pause for now.
Okay. Well, actually, sometime before, I don't know about yesterday night, but a few days back, the swap markets were pricing a cut even as early as December. Right now, I'm told by some dealers that they are pricing in February. So clearly, this market has seen it as slightly more hawkish than they expected at least a week back. The cut expectation is pushed to February. My sense is that people are playing an electoral guess over there, April or February, but maybe they are going with February because of an electoral pre-election expectation. In any case, by then we'll have a very clear idea of food inflation as well. Kharif and Rabi will be in. What is the bond market taking away by way of liquidity? The governor did say that 2,000 rupee notes are coming in. He has given the clear impression that liquidity is still ample, and that is why the withdrawal of liquidity stands. Amandeep, your thoughts in terms of liquidity and bond market takeaways?
Thank you, Lata. I think on liquidity, clearly the governor has articulated their desire to keep liquidity within a much narrower band, since they need to maintain their withdrawal of accommodation stance. So, beginning of this month, thanks to the 2,000 rupee recall, we had seen SDF numbers shoot up to almost 3 trillion plus. That's come down now because of the variable rate reverse repos to just under 80,000 crores. So I think that's more or less in line with the kind of levels we were seeing prior to the 2,000 rupee recall. So my sense is that they will like to keep operative rate at the repo rather than it come down to the SDF rate, and that will ensure that the liquidity in the system will remain somewhat very close to the neutral zone. And that's effectively implying that, the SDF numbers and maybe the durable liquidity in the system does not exceed about 1 trillion odd rupees. On the rate front, while you're right, most of the announcements in the policy were as per market expectations, no surprises there. But I think, there is a slight tilt of hawkishness in some of the additional comments which the governor made, two of which, in my view, clearly articulate the fact that, there is a lot of uncertainty in terms of the inflation trajectory going forward. And while we may have some comfort drawn from the 5%, inflation forecast, but the number of risks which he highlighted and the allusion that he had to, what has happened in Canada, Australia, beginning of his speech, combined with, what's also happened in New Zealand earlier, does indicate that the future path of monetary policy is somewhat uncertain. So effectively, that's kind of also driving the current pause and maybe, a furthermore pause in some of the subsequent policies, because they want to keep their options open. And having seen the experience of other economies, maybe they want to, make sure that whenever they do pivot or whenever they do change, they do have sufficient grounds and enough data to prove it. Between the last policy and the current, policy, if you really look at the data trends, there is nothing material which should actually influence their decision on either side. Finally, the other comment which I think, I would agree was also referred to by another panel member, was largely around the fact that, he's been reiterating that the 4% inflation number is more material from their objective. And if you recall, in the post-policy speech in April, he alluded to the pre-pandemic average inflation rate of 3%, which is when they were cutting rates. So my sense is that, while we may be comfortable with a 5 or sub 5% average inflation, but the 4% and the reiteration of the 4% target does indicate that this pause may be a bit longer than what was anticipated. And it's reflected in the swap yields, right? I mean, you've seen actually the 1 year move up, the 5 year also more or less go back to the April policy levels, indicating that the rate cut expectations are further moving out. Earlier, they were as early as October, moved off to December, and now they're indicating February, which I think is maybe more pragmatic.
Okay. All right. Actually, even February is an 80% chance. That's how I should put it, is what the dealer is saying. It's not as the swap markets are saying 25 bips in February, but an 80% chance only. So for all you know, Kaushik's point of April, 25 bips could be. But the important point is this is not what the swaps were pricing in. The swaps are pricing in something better. And as Amandeep said, on the margin for the bond markets, this is a little more hawkish than they were expecting, especially the inflation number, which has come in at 5.1 compared to 5.2, considering there is a good 60 basis point cut in their Q1 expectation. Q1, they were standing at 5.1, now they are 4.6. Half a percentage point cut in inflation in the first quarter. It still means that for the full year, they are not willing to go down much. I guess these are El Nino fears and the fact that rice prices have already risen. MSP is higher than expected. So playing caution over there, and therefore rate cut expectations have clearly been pushed out. That may also explain some bit of caution in the stock markets. Mr. Ashwini Kumar, there are a lot of developmental announcements. None of them seem to be terribly material, except that in the call and notice market, now how much you lend is a limit you can put in. RBI will not put in any limit. For a person like you, it must be a very big freedom. You all are usually lenders in the call market. Is that big?
Yeah, so it is a much more, it has eased the way in which we handle these things, because whenever some limits were set by RBI, then there is always that pressure to actually reach out to them and maybe request for a higher limit. So in that sense, the shift to the principle-based regulation, as the governor has been saying for some time, from a prescriptive regulation, this is one of those steps. I would rather urge more than this. We are a lender, you are right, but more than this, I think the more significant announcement is the digital first loss guarantee guidelines, which are going to come in and will clear up the space around this lending, which had increased, then fallen off because of the lack of clarity, and now hopefully should pick up again. And that the linkage to the financial inclusion from that part, because these are typically small ticket loans, I think that is a much more significant announcement. Others are simplification, and we will watch out for the guidelines on compromise, OTS, restructuring, etc., which he has said that will be issued in some time. So we'll wait for the detailed guidelines to come. Many of these the significance of these will then be known much better than it is now.
Now, I take your point, sir. I thought that first loss default guarantee rules are going to be made, I mean, they're going to guide that market. That's very important. Because it's an unlisted market, I didn't pay too much attention to that. I don't think there are too many listed players in that space. But maybe my startup colleagues in the startup team will be looking at valuations for the, fintechs on account of this. Ritu herself is quite a master at that. And maybe by end of day, we will have some clarity. But these are guidelines that are going to be announced. That's always welcome. When Reserve Bank issues guidelines for a market, that market gets a legitimacy. And so that may be actually positive for fintechs. But again, that's an unlisted market, not a public market. The bigger point that Mr. Tiwari is making is that some guidelines are expected in terms of compromise settlements in bad loans. This is also very good because it will guide banks on how to do write-offs. There is a charge sometimes that, NPAs are hardly resolved. You're only writing it off by adding to your capital or your retained profit. Perhaps some rules in that will also help bring some legitimacy and cleanness to that system. But both these are hygiene matters. I don't think they move the needle in terms of, credit cost or EPS. Am I right, Mr. Tiwari? Nothing to impact earnings.
You are right. See, these are things because in our regulation, which the RBI does in the supervision exams which happen, many times some confusions keep coming where there is lack of clarity and therefore difference with the teams. And therefore, we have been taking up with RBI on many things in these areas. And RBI has been saying that we will clarify them appropriately at a quick time. And maybe some of these things will be addressed now when we go along. You're right, it will not cause a much larger shift in terms of credit costs and all, but each account resolved in a proper manner helps. So in that sense, this hygiene or whatever way it extends, I think it will be very useful to the banking system, especially for banks like us, which have large portfolios, even though the percentages are small.
I take your point, sir. So that extending of these hygiene conditions and rules make it easier to reach compromise settlements. To that extent, should be easier. Gentlemen, we are winding up this discussion. But of course, we will be back at 12 when the governor addresses media and takes media questions. But before that, may I have a last, what you call rapid fire question? When do you all expect the first cut? Let me start with you, Abhik. When is the first cut, you think?
I think in February next year.
February. No, only one word. Let's make it rapid fire. Kaushik.
We are sticking with April. But I wanted to give you a little bit of reason you like it if you hear it out. Why April?
No. First cut. Sorry. Rapid fire, Kaushik. One word.
April.
All right. Amandeep?
I think I'll go with the current swap markets, February.
Mr. Tiwari?
I don't want to speculate on governors' rate cuts and all, so I would pass this question. Thank you.
Right. Okay. All right. Maybe I will not toss the other questions to you because they're more economist questions. What's your inflation target now, Abik?
Average inflation, 4.8% for the year.
4.8, also much lower than the governor. And Kaushik?
5.2. We are maintaining at 5.2, keeping the buffer.
Okay. Okay. And any tweaking to your GDP forecast, I mean, after the recent events? Kaushik?
So, Lata, we are at 6%. We haven't changed it after the GDP data for January, March. So, we are holding it at 6%.
Got it. Okay, Abik, yours?
6 to 6.2%.
All right. Got it. Gentlemen, thank you very much indeed for your quick parsing of the Reserve Bank monetary policy. The verdict from the market itself is that the complete status quoist tone maintained by the governor has been taken as slightly hawkish. The repeated insistence that they won't be satisfied with coming in within 6% or 2 to 6% band, but wanting to go to 4%, plus the fact that the governor did not even mention that pause is not pivot, clearly indicates that they are as far away from pivot as one can think of, at least further than people envisaged previously. The fact the inflation forecast also is not as dovish. It has been cut by only 10 basis points. That also will be taken as marginally less dovish or more hawkish on the margin. The verdict of the market itself is closer to 7%, that is the 10-year yield, compared to 6.98 yesterday. The complex of reactions is maximum in the swap market, where until a few days back, the cut was priced in December. Now only an 80% chance of a cut in February, again indicating that the market has taken it as slightly hawkish, oh so slightly hawkish, but otherwise a largely status quoist and an unexpected lines policy from the Reserve Bank governor. Let's see if he adds more color when he speaks to the press at 12 o'clock. That's when we will meet you. Thank you for watching this special coverage of the monetary policy. A break and then other news continues.